Welcome back to Fast Money. Another record day on Wall Street with the Nasdaq closing at a new all-time high. And our next guest says there are three high flyers in this record rally that could come crashing down. Class is in session with the Dean of Valuation, Damodaran, finance professor at NYU. Professor, always good to see you.
Good to be back.
Let's start off with Tesla. And before you actually dive into your valuation analysis, at what point did you think Tesla was not overvalued? I sort of want to get that out of the way.
I sold it. I mean, given the stock split price, I sold it at 120, and you can see how much money I've left on the table. But at this point, I don't even try to value Tesla. I just try to reverse engineer from the market cap what has to happen for that stock price to be justified. And here's what I see. I see a company that's being priced to deliver more than $500 billion in revenues with margins like a software company. Now, there are some who believe that that can be pulled off. I'm skeptical. I mean, to me, that if they can pull it off, that is something that no company in history has ever done. So I'm just looking at the market cap and saying that is a huge mountain you got to climb to justify that market cap.
So when you said a software company, some might argue, bulls might argue that the software, the intellectual property component of this company is much greater than it being just a hardware company, an auto company. The miles driven for the autonomous driving aspect of the company should be valued much greater. And so maybe you can get to the valuation there. If you imputed a higher valuation for those parts of the business, can you get anywhere near where it's valued right now?
See, I think there are pieces, and this is why I think Tesla, you can get to different valuations. There are pieces of the story. Each piece is justifiable, right? I mean, there is a part of Tesla that's software. For instance, a car goes with software, and they've talked about selling the software separately. The question is whether you can get margins that are 15, 20, 25%, which are software margins, with the revenues that a traditional automobile company has delivered, $500 billion. So I think it's combining the different pieces of the story that makes me uncomfortable because those pieces usually don't go together. I mean, think of Microsoft, 22% margins, but $130 billion in revenues. I mean, we're talking about Tesla having 4 times as much revenues and margins like Microsoft. That's going to be a tough hill to climb.
Let's move on to Zoom, Professor, and I'm going to start off again with the same question. At what point did you think Zoom became overvalued?
I think very early in the pandemic, Zoom and Peloton to me became the symbols of lazy investing. Lazy investing in the sense of, hey, I want to take advantage of the pandemic. Let me pick the companies that I think will benefit. And guess what people zoomed in on? What they were working on every day, Zoom and the fact that Peloton was benefiting. I think that they've benefited. And don't get me wrong, I love Zoom as a company. I think they've got the perfect platform for this virus. But at the same time, I think I think the market cap has run way ahead of what the company can actually deliver in terms of revenues, especially after we go back to work. I think some people will stay on Zoom. I think the story is still much bigger than it was before the virus hit. But I can't see it being big enough to justify the prices we're paying for this company.
Dean Aswath, it's Tim. Thank you. What about the competitive landscape in that same space? I mean, that's got to be part of your argument here. It's extremely competitive.
Exactly. And I think, and it's got big players with deep pockets, right? You got Cisco and you got Microsoft. Neither player is going away. So for me, that the problem for Zoom is even if the market for online meetings, teaching is much bigger, it's going to face a lot more competition going forward. And that's something that I don't think has been priced in right now.
You mentioned Peloton. That's a third stock that you're saying could come crashing down. And I'm wondering if there's an argument that this is a company that could actually become a software player with bigger margins as opposed to a company that sells bikes and treadmills.
And I think that's going to happen. It's going to become a subscription model-based company. I mean, when I originally valued Peloton in September of 2019, I valued it as a luxury fitness equipment company with a subscription business on the side. Today, I value Peloton as a subscription business with a fitness equipment business on the side. And I think that it is going to succeed at that. So when I say the value is too high, it's still going to be much higher than it was before the virus. I just don't think you can justify the prices that investors are paying for the company because that's subscription business. I mean, right now, they're charging $13 a month for the subscription. You pay $16 a month for Netflix. On a relative basis, that seems to be a pretty expensive subscription for a fitness app. And I think that's something you're going to start to see come under pressure as well once we stop staying at home and we start looking at options.
Professor, it is always great to get your insight. Thank you very much. Aswath Damodaran of NYU. Peloton and Zoom, Guy, examples of lazy investing. Do you agree?
You understand what he's saying there?
Yeah,
I mean,
totally.
I think he even backtracked a little bit on the lazy. But I understand what he's saying. Like, oh, stay at home. What are people going to do? They're going to ride their bikes, going to do Zoom videos, buy the stock. Sort of the Peter Lynch in 2020. I get it. But my pushback would be, I would submit at this price, even if Zoom is 75% of what they're doing now in 2021, the stock is still pretty reasonable, I think. And I think the world has changed fundamentally. And although Peloton, if this had just lasted a month, I would have agreed with him. We're 9-10 months into this. I think people have come attached to their Peloton. I know I have, and I know you have. And I think if Kay Fine in 09 were here, she'd say the same thing. People love their bikes. And again, I ride with certain people, and I'm steadfast in that. And I'm going to stay true to my Peloton roots, Melissa.
You ride with people? Oh, you mean like the instructors, not... Do you ride with Karen? We don't ride together, that's for sure. The instructors.
The instructors.
Got it.
No, we don't ride together.
We do not ride together.
The instructors.
Grasso, just quickly, which is your pick?
So when you look at the overvaluation, I think that Zoom is overvaluated. And if you look at it, people are going to get back to work. And then the people that don't go back to work, that are sitting home, they're probably going to Zoom a lot less because there's going to be people in the office space, and they're not going to be as relevant anymore. So Zoom and Peloton, just think about how much money wasn't spent on vacations and people bought the bike. It's an expensive bike. There's competition now. And I think once people start to take vacations, once people start to get out of their house and do other opportunities for them to spend their money, they're not going to buy the bike. Guy loves the bike. It's a great product. It's cult-like. Everyone loves the product. But I think you're going to wind up seeing sales actually decelerate in a significant fashion moving forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.